este caso. Gracias, Sergio. Vamos ya al análisis. Jay Pelosky, TPW Advisory Founder. Good afternoon, and thank you so much for being in Negocios Televisión as always.
Happy to be with you.
Jay, I don't know if you've listened to what's happening right now in the Senate in the United States. We've been listening to the ex-CEO of Signatura Bank, of Silicon Valley Bank. They basically seem to say that it was not their fault that both banks failed. What do you think about these words of both ex-CEOs?
Well, I only listened to a little bit, but I think one of the congressmen or senators said it sounded like the old excuse you give as a school child that the dog ate my homework. And I thought that was pretty accurate. But, you know, to be honest, we're very focused here at TPW Advisory on trying to look forward, not back. And so for us, what's important is that the regional bank index in the U.S. Bottomed several weeks ago. As of yesterday's close, it was up about 8% from that bottom. The latest report about deposit flows from last Friday suggested that deposit flows have ebbed considerably. And when you look at the VIX for stock volatility, or the MOVE index for treasury market volatility, or the spread of high yield over Fed funds, which is a good way to look at concerns about credit crunch, et cetera, none of those things are suggesting systemic risk. And so, as you may recall, that's been our view from the beginning. And I think it's important to note that from the Friday before, when Silicon Valley Bank first announced it was in trouble, through, again, last Friday, the S&P is up over that period. Up, not down.
Jay, debt ceiling negotiations are still on the table. Joe Biden and McCarthy will be meeting today at the White House. They've been meeting for days, and we still don't have an agreement on the debt ceiling. Should today be different, Jay?
I'm sorry, should what?
Should today be a different scenario? Do you think that we'll have an agreement today or not?
I don't have a crystal ball, so I really don't know. But again, I point to the indicators I just mentioned, right? We like to let the market tell us rather than we try to tell the market what's going to happen, right? We think that the market is a forward-looking discounting mechanism. And so it's already incorporating all this into the price. And so the fact that all the various risk and volatility indicators are not showing real signs of concern, then we don't think we should be very concerned. And so while it remains up in the air as to when there will be an agreement, we do expect that there will be an agreement. And if the stock market were to sell off on worries that there wouldn't be an agreement, we would see that as an excellent opportunity to add to positions in the equity market, because we believe that in the second half of the year, inflation is going to fall considerably. We're probably going to have 3.5% inflation in the U.S. by the end of June. The Fed is on hold. No more interest rate hikes. The economy is starting to, we believe, accelerate. I know that's a minority view, but we believe it's in the early part of an acceleration. And most importantly for stocks, earnings are being revised up, and forward guidance of companies is being revised up. And so those are the reasons why we would say if there's any weakness because of fears over the debt ceiling, that should be used as a buying opportunity.
Jay, credit default swaps for the U.S. debt are already trading higher than those for Greek debt, for example, or Brazilian debt even. Is this something we should worry about?
No, I think that's what we call the curtain of FUD, fear, uncertainty, and doubt, something we've been writing about for quite some time, going back several months now. There's just always these negative headlines and different data points that are pulled out and held up as an example of why investors should be afraid. And investors are afraid, right? Record cash positions, record low equity allocations, record high bond allocations. So all that FUD, all that fear, uncertainty, and doubt is, again, priced into the market. In the CDS thing, the point to remember is it's a tiny market, okay? The volume in the CDS market is tiny. And therefore, whenever you have a little bit of volume going into it, the price has to explode to absorb the volume. There's no way anyone rationally would think that the U.S. risk of default is higher than, Brazil or Greece or whatever other country you kind of want to talk about. So the point is, it's a very misleading indicator because it's a very thinly traded financial instrument, and therefore can be manipulated by people who want to try and create this fear environment for probably their own positioning in terms of being short. So no, we don't pay any attention to that indicator at all, zero.
Jay Pelosky, TPW advisory founder, thank you so much as always for being in Negocios Television. We'll see what happens this afternoon with the debt ceiling and that meeting between Biden and McCarthy. Thank you, Jay.
Thank you. Always great to be with you.
Bueno, mientras tanto miramos a